So when I was in U.S. Navy boot camp, we would compete with other divisions for competition flags in areas such as academics, athletics, military drill, and so on. Well, our division commanders had promised us a pizza party if we would bring home the flag for athletics. So all of us, having been at boot camp for about a month and a half at that point and not having tasted pizza, we were thrilled for that. So we worked our butts off. We captured the athletics flag, and the night came for the pizza party that they promised. Now, the recruit division commanders did not lie. They ordered pizzas, and they called some of the other division commanders over from the other divisions to have pizza, and they all sat at the front of the room and then walked around with pizza while we did jumping jacks, squat thrusts, push-ups, sit-ups. You get the idea. So it was a pizza party for them, and it was called cycling for us. We were worked out. The pizza party was too good to be true, and these dividend stocks are also having high yields that are too good to be true. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are working to make work optional through stock and crypto passive income. A little bit under the weather here that I'm getting over, so apologies for the voice, but we're going to get through it. Want to get this video out. As dividend growth investors, we need companies that are paying a stable and predictably increasing dividend. So one of the worst things we can do is chase yield and only look at companies paying really high yields of 8 or 9% and higher without good reason. Sometimes though, if the market does crash and companies were already paying a solid yield, then that yield will go up. Because remember, as the price goes down, the yield goes up. But there are companies that are trying to lure in investors in a sucker bet and get us to invest in their company. So we have 3 companies for you that I would stay far away from, and we'll start with number 3, which is Prospect Capital, ticker PSEC, a $3.2 billion mid-cap BDC that lends and invests in private businesses. One of the things that you always have to remember is you cannot just look at yield. So one of the very first things I like to do is I have an app on my phone that is NASDAQ. You can try that, or you can also go to NASDAQ.com. Type in the ticker, click on the name, and what you will do is just click on dividend history. We'll see they have a very high 9.1% yield, paying out 72 cents annually. Now they do pay this every single month. They're at 6 cents a share. But as we scroll down, we have to go back a few years, and we'll see that they were at 0.0833 in August of 2017, and they cut to 6 cents the next month in September of 2017, where it's been ever since. And if we go back even further, we'll see that in January of 2015, they cut from 11.0625 to 0.08333. Before that, though, check it out, they had been raising the dividend every single month. That was impressive, and they started doing that in 2010, but we can see they also had cut 40 cents, 40 and a quarter. They had been raising 41 cents all the way down to 10 cents. So they've had a history of cutting the dividend. So right away, that's just a big red flag to me. When you see a history of a cut and then a few years of a freeze, and then a cut, and then a few years of a freeze, it's pretty much a pattern with Prospect Capital. So I like to use Wall Street Journal, but they had some incomplete numbers for the earnings statement. So for PSEC, we're going to be on Market Watch, and we'll go to the bottom first. By the way, the first column is 2016, and to the right is 2020. But when we go on Wall Street Journal, it'll be reversed. 2020 will be the first column all the way to the left. They have not been diluting shares. They have not been increasing more shares to say. Earnings per share had grown from 29 cents to 70 cents to 83 cents and then dropped 52% to 39 cents. And in 2020, they are at -4 cents per share last year. Now, a lot of these were affected by COVID, which is understandable. And let's take a quick peek. The revenue was at $767 million. They dropped 21%, and then they bounced up to $639 up to 718, down to 615. So they're in that 600 to mid 700 range. That's pretty steady for them. And then one of the most important metrics, of course, is the free cash flow. That's the money they're left over with. And 472 million in 2016, down 10% to 17, down 41% to 45. 252 they went up, and then in 2020. So that's been really choppy as well. So out of these three companies we're going over to avoid, Prospect Capital is the strongest, but because of the history of dividend cuts, I would stay away. Number 2 on the list is another popular one, which is ticker AGNC. AGNC Investment Corp is an $8.3 billion mid-cap that primarily invests in agency residential mortgage-backed securities on a leveraged basis. So then we'll plug AGNC into NASDAQ, see that they're paying 9.9% dividend yield, good for $1.44 annually. Now they are a monthly dividend company, but let's check that out. Currently paying 12 cents, and they cut from 16 cents to 12 cents in April of 2020, which is understandable because of the COVID pandemic, but they cut from 18 to 16 cents in May of 2019, and they were frozen at 18 cents for quite some time, but they cut from 20 cents to 18 cents in August of 2016 and cut from 22 cents to 20 cents in May of 2015. Now it looks like there was a big cut here from 65 cents to 22 cents, but all they did was they shifted, as you can see, from being a quarterly dividend paying company to a monthly dividend paying company. So that's all that is. That's not a cut. That's just being paid out as a monthly dividend. But before that, check it out. $1.40 they were at for a while, cut from $1.40 to $1.25 in March of 2012, cut from $1.25 to $1.05 in June of 2013, then cut to 80 cents. I've lost track of how many cuts AGNC does. That's what they do. Just look at their dividend history. They cut the dividend frequently and systemically. So I like to use Wall Street Journal just a little bit better than MarketWatch, a few less ads. The 2016 year is all the way to the right. So we'll drop down to the diluted shares outstanding and check that out. They had 332 million in 2016, 359 million, 441 million in 2018, 2019, 541, 552. So you can see every year they are increasing the amount of shares, which is reducing your investment in the company. Now, like I said, that's okay if they're diluting shares, if they're offering more shares and they're bringing in more money and they're investing it and bringing in a good return on that investment, which should be reflected in the top line sales and the bottom line cash flow should both be growing. So let's check out what AGNC is doing with that diluted money that's coming in. Earnings per share went from $1.79 to $2.04, good for a 14% increase, but then down to 21 cents, loss of 89%, jumped up 400% to $1.16, and then in 2020 dropped to 66 cents for a loss of 156%. So earnings per share is really choppy. Now top line growth, we can see the growth right here in the number. Went from negative 11 million to 1.5 billion. So that was a huge jump of 14,563%. That looks really good. And then it only went up 20% from there in 2018. 2019 dropped 43% before COVID and then dropped 68%. So top line has been diminishing ever since 2018. And the bottom line free cash flow went from 1.3 billion to 1.2 billion, loss of 6%, 1.1, loss of 11%, 1.18, gain of 6, and then 1.7, a gain of 48%. So that's choppy, but at least the bottom line has been expanding the last few years. So that's a step in the right direction. In the last 5 years, they've diluted the investor by 66.3%, but the bottom line growth has only been 29%. So that's still a net negative to the investor. You have a dividend cut that you regularly withstand, and you are losing your investment share without buying any new shares because of the dilution, and they're not growing as a company. So for me, AGNC is a no-go. And the number one yield trap that I would steer clear of is none other than a very hot and talked about company, NLY Capital, ticker NLY, which is a $12 billion large cap that invests in and finances residential and commercial assets. Plug them into NASDAQ, we'll see that they have a very big yield of 10.63%, paying out 88 cents annually. Is that sustainable? Let's check it out. They are not a monthly dividend paying company, but here we go. So they were at 22 cents. They cut from 25 to 22 in June of 2020, cut from 30 to 25 in June of 2019. Now they're at 30 for a while with the occasional cut here from 30 cents to 26 cents. Then they pop back up to 30 in September of 2016. And then they cut from 30 cents to 7 cents in September of 2018. But then the next quarter, they pop right back up to 30. And they've been at 30 for quite some time, but they did start out going back to 2013 at 40 cents, where they cut to 35, and then the next quarter they cut to 30 cents. So again, much like AGNC, NLY Capital has a history of cutting that dividend. One thing I want to point out that I get a kick out of is check this out for the analyst ratings. Currently, 7 analysts have a buy rating and 6 have a hold with no sells. It's a funny thing that not many analysts will ever give a sell rating, and this is something that you should always take their ratings with a grain of salt for a few reasons. First off, most analysts work for banks, and the banks have a business relationship with the stocks, that they underwrite their stocks that they sell to the public. And a lot of the analysts have also relationships with the companies, getting on earning calls and such like that. So they have a vested interest in not pissing off the companies by saying that they're a sell. And the worst that they'll usually go is a hold. And most analysts also have interest in with the big hedge funds and the big institutions. And a lot of these aren't doing what we're doing, where we're buying and holding for years and decades. A lot of the time they're thinking in a matter of months, maybe a 12 to 18 month time frame tops. So that is factored into a lot of their buy, sell, hold ratings, which is why you hardly ever see any sells. They want people to keep buying so they can push the price up. And it also affects the earnings per share and such when they give those EPS estimates. So always, always, always take the analyst ratings with a grain of salt. And this is why it's so important to do your own research and have your own thesis and know the numbers, because you can always be told a story, but the financial statements, if you should choose to look, will have all the truth there and all the answers, and that will tell the real story as opposed to the story that somebody is telling you. So we got 6 buy ratings on NLY Capital. Let's check out what they've been doing with the shares. 970 million to 1.06 billion to 1.2 billion, 1.435, and then they actually had a reduction in 2020 to 1.415 billion shares. But since 2016, they have diluted 45.9% your investment in NLY Capital. So that earnings per share of $1.39 to $1.37 is down 1.44%. 2018 down 104% to negative 6 cents, negative $1.60. I mean, that's just crazy. In 2019, down 2,488%. And then thankfully, they've gone in the right direction, at least. Now in 2020, they're negative 73 cents a share for a gain of 54%. But the fact is that the last 3 years, they have been negative earnings per share. Now, the top line in 2026 was $1.9 billion. Grew that to $2.3 billion, looks good. But then in 2018, they dropped 11% to $2.080 billion. They dropped even further in 19 to $1.8 billion, dropped to $1.4 billion. So they have been losing top line revenue growth solidly since 2017. And again, remember with the REITs that you can't always look at retained earnings because they have to pay out 90% of their taxable income in order to maintain that favorable tax status as a REIT. And the free cash in 2016 was $6.8 billion, grew to $6.9 billion for 1%, and then just a massive drop in 2018 to $2.6 billion, loss of 61%. And then in 2019, they went negative $1.1 billion in free cash, which is just awful. But at least in 2020, they came back up on the positive side at $536 million. So Annaly Capital has had a free cash flow reduction in the last 5 years of 92%. That is just not going to cut it for us. And it would be a different story if maybe they were trimming the dividend, but they were growing the company, growing the top and bottom lines. But I don't see them doing that. And for that reason, I would stay far, far away from Annaly Capital as a dividend growth investor. So remember, this is just kind of a quick exercise that I like to run through to see if I should dive deeper into a company that I could potentially invest in. Because remember, you're buying a part of that business, part of that company. So I'd love to hear what a yield trap stock is that you know of, or what is a story of something that was too good to be true. Let us know in the comments below. And for something that is not too good to be true, that is solid and is a monthly dividend paying company, check out the video we did right here on Realty Income that will be merging with the REIT, and I will talk to you there.